Welcome to 2016 and welcome to TheoTrade. This is Don Kaufman. The reason you are looking at the TheoTrade home screen is none other than I'm going live this week. Yes, we were planning on kicking off January 11th, kind of in our beta phase, but I'm home, I'm bored. It's the new year. We're going to go ahead and go live on January 4th. Again, that is going to be Monday, January 4th. We're going to go ahead and we're going to go live in the chat room. Now, not every one of you, okay, has the ability to log in during the trading day. I am going to go live in the chat room, which I'll take you into momentarily, okay? At the market open, that's 8:30 Central Time. I'm going to be spending approximately 2 hours per day from pretty much here on out in the chat room. We have a number of other presenters that are also going to be coming on, really kicking off throughout the course of this week, next week. But again, TheoTrade goes live. Okay, there's no cost for any of this right now. We are still in beta phase. We invite everybody. And again, if you can't come in here, we've got archives that we're going to be posting as the week progresses of what goes on in the chat room over there. Our chat room is not just about talking about markets. It's going to be a tremendous amount about education, tremendous amount about coaching. The reason I brought you to the TheoTrade homepage is I want to show you, here's the member login. Okay, if you do not have your login credentials, or if you did not, okay, come in and opt in for the beta phase, all you have to do is go to www.theotrade.com/TheoChat-free. That sounds like a lot. Don't worry. We're going to send you an email with the link in there. Again, we're going to send you an email with the link in there. And again, if you already registered for the beta, okay, we're also going to send you an email giving you your login credentials once again. Now, when you have logged in, okay, this is what it's going to be. All right, so I'll go to the member home first of all. Welcome again to the beta users for TheoTrade. What you want to do is just come over here to the right in the middle of the screen over here, the member chat room. Again, says we're going live January 11th. We're changing all of that. I'm going live, okay? And I'm going to go live, again, this coming Monday, January 4th, still in beta, but we've had just a huge outreach of support in the last 2 weeks since we started talking about TheoTrade, so why not? I'm here, I'm ready. This is what our chat room is going to look like. For those of you that are there on Monday morning, market open, I'll be live. It'll appear, believe me, my screen will show up here, and of course you can communicate with us just down below in the Theo chat section down below there. Great. Enough said. Again, your login credentials will be emailed to you once again. For those of you that are not registered for beta and would like to join us in there Monday or want to check out some of the archives, we're actually going to send you an email to that effect. All right. Now, let's go to the markets, talk a little bit briefly about, okay, 2015, because I really want to talk about more or less what I see in 2016. And there's all these, market pundits out there talking about, this is what's going to happen in 2016. The only thing that I see for 2016 pretty definitively is the volatility continues. So we saw pretty decent amounts of volatility, and, volatility can be measured in many ways. A lot of people think, let's just measure it via the VIX. Okay. And yeah, I could do that, but here's just happens to be a 9-month on the VIX. Again, if you want to go to the full year over there, we'll just go to like a 1-year daily on the VIX. It doesn't look too wild, not too volatile. If you look at the historical volatility though, which is actual stock price movement, it's fairly substantial. Again, we had a wild spike in the VIX August 24th, neither here nor there. Okay. I'm going to give you a little explanation, though, of why volatility continues in 2016 to an area that I've been harping on now for quite some time. And it's a story of divergences. And these monstrous divergences exist in major products, not even looking so much at individual stocks. And I will point out some individual stocks, but divergences exist, okay, in some very, very large products. And I'm going to start off with looking at a few of the major index products kind of year to date. So this happens to be the Russell. All right. In this case, I'm going to go ahead and close up my left side bar because I want you to get a good clean look at this. And again, kind of the setup of why I believe we're going to be in a substantial period of volatility, and not necessarily just for 2016, until some of these large divergences correct. When I talk about divergences, so here's the Russell. I'm going to go ahead and I'm going to put this to a percentage view because I like to show prices percentage just to give you, all right, what did the Russell do for 2015? It was down approximately 5%. Okay, so great. The Russell's down 5%. Captain Obvious. Thank you, Don. Great. Now let's go over to the S&Ps. If you're not aware of this, the S&Ps, where do they finish the year? For the most part, massively unchanged. I'm just happy they were slightly down. Almost 0.7% they lost. That doesn't necessarily mean you lost over there, but come back to that in a moment. And last but not least, in terms of like the major index products, I'll look at the NDX, which is none other than the NASDAQ. Okay, and I prefer looking at, the granddaddy of all the products rather than looking specifically at something like an ETF like the Qs. I'm just looking at, what I believe to be the cleanest take on it, which is the NDX, up 8.5%. Okay, so now the story I'm going to give you here is the divergence. And again, I've been talking about this for quite some time, but if you start to go back to markets historically, divergences exist, but divergences, okay, when I say divergences, I'm talking about NDX versus, for instance, SPX, okay, or the small caps, the Russell versus the NDX versus the SPX. Let's go in there and let's take a look at some of these divergences. So we're going to go back to the SPX, and we're going to make the SPX kind of our baseline. And by the baseline, I mean, we're going to do a comparison chart. And I use, I'm not a big market technician, but I use comparison charts time and time again to explain these large types of divergences. So here I've brought up a 1-year daily SPX. Okay, and I just want to give you some orientation because if you're following along and trying to play the thinkorswim at-home game, like I clicked pretty quickly on thinkorswim. It's officially my 16th year on this trading application. I think I finally know it. So you go to the SPX, then drop down over here to studies. Okay, you're going to go to add study, compare with. So we're going to compare the SPX. Okay, and just go right up here to the NDX. So let's just start with, again, SPX versus the NDX. Clearly, you can see outperformance of one versus the other. Now, anytime you do a comparison chart, it's important. Change the style, okay, from candle, change it over to a line. So you always want to compare line to line. It's a much cleaner way to do comparisons. And what I want you to see is some of the divergences that existed that, you had the S&P really performing well and the NASDAQ not so well. And then all of a sudden they came together. And then look what happens when there's an extreme amount of volatility. They fall just lockstep. Okay. And that's one of the keys in here is that during bouts of extreme volatility, markets will unite, okay? And they will follow each other to a T. Now, you may have one that's a greater percentage loser than the other, but they come back together. They converge during periods of extreme volatility. So then we traded in lockstep for a while. They diverged again, okay? Now, let me back up for just a moment. Let's not just look, all right, at a 1 year. You can go back to like a 3-year weekly, and you can see that markets are extreme in their divergence. I mean, you go back over here and you'll see, well, they were a little diverged back here, Don. Like, I get it. Again, bout of volatility. What do they do when there's a bout of volatility? They converge again. All right, bout of volatility. This is back in August. Here again, we've got a fairly substantial divergence. Now, let's add one more product into the mix there. Let's go back down to the 1 year daily, and you can check out products converging and diverging for decades. And that's why I use the SPX, the NDX over here. And you'll see how large the divergence is right now if you go back a substantial amount of time. So go back over to studies, okay, add study, compare with, and you'll look up here, you're like, there's no Russell. I want to put the Russell in there, so I have to go to custom symbol, just type in the RUT. R-U-T, R-U-T. Now you're getting a little bit more perspective, okay, of what? All right, look at the NDX just taking off versus the S&P versus none other than the Russell. And again, although these types of divergences exist and can exist for substantial amounts of time, they always end in bouts of volatility. And this is kind of crazy, but I'm going to pull up like a 5-year weekly and you're going to see some just wild divergences. This isn't just wild, okay? It's as extreme as it gets. Now, the divergence itself in the NASDAQ, okay, versus the S&P. And by the way, yes, you're looking at a 5-year weekly, and yes, we've still returned 60% in the S&Ps over the last, 5 years. Not bad, not bad. You're like, you know what? I was just long the markets and I was happy, okay? But that's not the kind of marketplace we're going to be in 2016. This is going to end. And I'm going to show you exactly why. If you look at the performance specifically of the NASDAQ, now individual stocks, you can point out, what did Apple do? So let's clear the board for a minute over here. Clear the board. When I say clear the board, just changing the symbol. What did Apple do year to date? And if you know, again, here's where all the market pundits were out there. They're like, Apple did not perform well in 2015. Thank you, Captain Obvious. Okay, Apple did not perform well. It was down almost 4%. Okay, so what does that mean? Okay, you have the largest market cap being down 4%. And it's the largest market cap not only in the world, but it's also the largest market cap, of course, then inside of the NASDAQ, and it doesn't perform well. Okay, what does perform well? Facebook, and this is, again, I've just been barking up this tree forever. Facebook, huge market cap, up 33% year to date. Okay, well, I guess not year to date anymore, huh? I have to rephrase the way I said that. Up 33% in 2015. Netflix. Now, Netflix does not have that substantial of a market cap. It doesn't. Okay, but it was still up almost 30%. It's only sitting around in the neighborhood of about 50 billion, give or take, which is not that large. Google is an absolute behemoth market cap. Google up, again, 47% in 2015. Amazon, if you just looked, Amazon, Google, Netflix, Facebook, okay, the story is very simple. Those are the stocks that actually drove the NASDAQ higher. You will watch those stocks throughout 2016. The largest single risk that I view, okay, I don't want to be long Amazon right now. I'll actually be entering into a number of short positions with options predominantly in Amazon to control my risk. And you're like, what are you, crazy? The thing just hit an all-time high. The answer is, I'm not crazy. This doesn't end well, because if a convergence is going to happen between the NASDAQ and the S&P, and it will happen in 2016, mark my words, these are the stocks that are going to get hit, okay, because they're what's causing the divergence. Now, to continue kind of onward and upward, sometimes, you got to sit back and kind of reconcile your own positions. I like to reconcile my own positions, and in my own positions, okay, I'm short a lot of stuff. One of the stocks that I've been short is Target. Okay, so I like to reconcile my positions, just decide, like, it's a good time, beginning of the year, like, do I really want to keep this position anymore? Here's my target position. I happen to be short. I'm outright short the shares. I'm short 700 shares. Okay, I'm up about, 8% of the trade. Again, all I'm doing is not showing you, good positions, bad positions. Okay, I want to give you a feel for, like, reconciling positions. I'm short Apple. In this account, I'm only short right now about 500 shares of Apple. Okay, I have been short Apple on and off for quite some time, but roughly I've been short Apple since $130. Okay, I continue to hold a short position inside of Apple. Okay, another one that I am, and probably one of my largest positions, I shouldn't say one of my largest positions. This is my single largest position. I am short 7,100 shares of the XLF. It was down just over 3%. I am short S&P futures. I am short NASDAQ futures. Okay. One of the ugly positions I have right now is, and I got them right where I want them. I'm also short Costco. I don't mind showing you an ugly position. Why? Because it's the reality of the marketplace. I haven't been short the whole year. No, I've just been short the worst portions of it. So if you're really interested in my Costco position, it's not going so well right now. I'm short 1,000 shares of Costco, but neither here nor there. Looks like I'm down almost 10% on that one. I said, I got them right where I want them. Oh, I like it. So how can I be short all these things? How can I be short all these things and still be like, okay? And the answer is that I sell premium against my short positions. And I sell premium predominantly in the SPX, and I have mild positions in there. But when I sell premium in the SPX, okay, the skew helps me substantially. So I just want to leave you with this thought coming into 2016 that I'm not short because I believe that the world is going to crumble every single day. Okay? I'm not a perma bear. Okay? Listen, the markets have been on fire for how many years right now? Okay? I'm sorry, but I don't see the risk reward of this as being appetizing to me. It doesn't make sense in my mind. And I'm not trying to convince you, but you look back over the last 3 years like, oh yeah, I'm drooling to want to buy this. I don't see it. Okay, I just don't see it. And that's, instinct as a trader. Okay, listen, there's nothing in the chart that's going to tell you you're going up or you're going down. It's 2016. I'm telling you, though, we're going to see substantial bouts of volatility. I opened up some options that are 35 days out. And the reason I did that, look at the skew in here. Look at these out of the money, okay, calls versus out of the money puts. And again, I'm just trying to get this into perspective on my screen so you guys see with me why I want to be short as well. Here's an option, okay, not too far out of the money. So I'm looking at what, $60 out of the money. So just go a little bit out of the money, same distance, $60 out of the money. I'll go down to these, this 1980 strike. Look at the premiums that you can collect for these puts. These calls are trading for what? $10. These puts are trading for over double. And they're about equidistant out of the money. And the way that I view it is, listen, I've been short all of 2015. I'm going to continue to be short for 2016. So I'm short 2015, but I'm collecting huge premium on being short and selling out of the money puts against my short positions because the skew is so large. And that's the kind of stuff that I'm going to be teaching here at TheoTrade. I mean, at this point, TheoTrade, listen, the gloves are coming off. Okay? When I say the gloves are coming off, there's nothing to hold back. Okay? At TheoTrade, I'm going to let you guys know right now, classes, chat room, coaching sessions, okay? Even when we do classes, big classes. I'm going to do a class. I'm going to take an entire Saturday on the Greeks. Already got it planned out. Can't wait. Excited about it. It's all going to be one cost. Check it out. It's all going to be one cost. So don't think that you just have to be part of our chat room over here. From classes to our coaching, okay? Everything is going to be included here at TheoTrade at one price. So join us. Again, you're going to be getting some emails to join the beta. There's absolutely no cost for beta. Okay, we are going live January 4th, this Monday at market open. Check out your email. You can always shoot an email to us if you need us. support@theotrade.com. Again, welcome to 2016. This is Don Kaufman. See you guys Monday morning. Get ready for it. If you don't catch me there, catch me in the archives.